Good day, traders, and welcome to another installment of the Big Picture, where we take a closer look at the current themes driving the financial markets and put it all together in a way that makes sense. On today's episode, we're going to continue our discussion of inflation expectations, and the current inflationary fears that seem to be driving the stock market. We're also going to talk a little bit more about the labor market, look at some economic data associated with the labor market and the likely implications that inflation and the labor market and changes in those things are to have on future Fed monetary policy, and by extension of that, the stock market. So stick around, lots to get to, and I'll see you on the other side. So jumping into the current intermarket trends, no real changes from last week to this week. So the same long-term, mid-term, near-term trends still in play in all of the major asset classes here. We did get a slight correction earlier this week in US equities, and that's really just a product of the current volatility environment. So jumping into the bear matrix here and looking at VIX, which is volatility on the S&P 500, pretty good gauge of overall market volatility. We see that we've been jumping kind of back and forth between above and below 20. And below 20 is what's considered the bulls bucket, right? That's where volatility is relatively suppressed, and you're not going to see a ton of spikes higher and lower in the S&P 500 generally in that environment. Whenever volatility gets above 20, things get a little more dicey, and you can expect larger moves in both directions. So as volatility has jumped back and forth between the bulls bucket and the chop bucket, we're seeing a little more excitement price-wise in the S&P 500 and equities broadly. So, this volatility environment definitely showing its face and giving us a little more excitement broadly in the equities market. This week also gave us another push lower in the US dollar. So let's take a closer look at that. Coming to our percent return over the various time frames here, we see over the last 12 months, the long term is down 10%, which is a substantial move lower in a currency, right? Currencies are generally much less volatile. So, the 3-month midterm trend there, more or less flat, down about 0.8%. Over the last month, down 1.5%. So that's what we're really seeing here, is this big push lower near the bottom of the range. So a continued move down, a continued weakening of the US dollar. Next, let's jump over to commodities, where we're still in firm long-term, mid-term, near-term uptrends, although this week we saw a little weakness. And that's odd, because generally one of the most reliable relationships in the market is the inverse correlation between the dollar and commodities. So with the dollar still continuing its move lower, you would expect that commodities would have continued its move higher. In reality, it did, but we just got a correction off the top end of the range this week. So let's take a closer look. Here looking at DBC, which is a broad commodities ETF, we see the long-term uptrend firmly in play, up almost 54% over the last 12 months, up almost 9% over the last 3 months, the midterm, up 3.5% in the near term this last month. We were down 1.5% this week, but taking a closer look, we see that that's really just a mean reversion from the high end of the range down towards the middle to low end of the range. So commodities still look really bullish to me, even with a range rank of 29%. Volatility is still relatively low in the space. So this to me is a good buying opportunity with this mean reversion back lower. And zooming in a little closer here to take a more detailed look at the very near term. This last week, this correction was on reduced volume, which are these blue bars here, and was not met with a huge spike in volatility. So both of those things adding to my thesis that this is more of a buying opportunity in the solid long-term, mid-term, near-term uptrends here in the space. And as long as the dollar continues to weaken across its major time frames, we can expect commodities to continue to do well. So the important factor here is, what's the dollar's next move? Do we get a continued weakening, or does the dollar begin strengthening and putting a kind of a headwind, a lid on commodities broadly? For now, I would expect the current trends to continue with the dollar weakness and commodity strength. And until we get data out telling us otherwise, I'll continue to position my portfolio accordingly. Turning to the 10-year yield, we see the headline is that the long-term, mid-term, near-term trends are all still up. But if we take a closer look, we'll see that we're in more of a consolidation pattern here in the near term. So the near-term uptrend is coming from this 1 month percent move. That's the trailing 1 month, up about 4.5% or so. But if we look at the last 2 months, it's really in this consolidation pattern where we're just mostly drifting sideways. So always good to kind of look at the detail of these things, because while the 1 month and 3 month percent returns are reading as positive, and they are, we're really seeing this sideways move, and it makes this near-term uptrend a little less reliable, because a consolidation pattern like this is a bullish consolidation pattern, right? So in the long term and midterm, we're in an uptrend, but over the last 2 months or so, as we've drifted sideways, it's really weakening that near-term trend. And this is the kind of thing that eventually will break out one way or the other. My current view is that yields are likely to continue higher, especially given investors' expectations of inflation being elevated, right? A lot of inflation fear in the market right now. So if inflation spikes higher, the 10-year yield is likely to continue higher as well. So the probabilities tell me that right now yields are more likely to move higher, but this consolidation pattern is bringing some questioning into that right now. So what factors are likely to come into play that would push this higher or lower? Well, generally, it has to do with inflation and the likely monetary policy in response to that inflation. So again, a lot of inflation fear in the market right now. CPI and PPI, which are two central measures of inflation, came out earlier this month and surprised to the upside. So a notable spike higher in inflation readings. So the market gets scared when that happens, because the thought being that, the Fed will have to respond to that spike in inflation by taking away some of their easy money policies. So again, we talked about this a lot last week. The Federal Reserve continues to support the economy through both their asset purchasing program and with reduced rates, right? The Fed funds rate is at 0.25 right now, so rock bottom interest rates. Both of those tools of the Federal Reserve have two effects. First of all, they support economic growth, and they keep a lid on yields, on prevailing interest rates. But if inflation starts to creep in, which it has already begun to do so, the fear is that the Federal Reserve will take away this economic support, this easy money policy. And if that happens, it's likely to slow economic growth. Now, the Fed has reiterated that it's likely to continue its current monetary policy. And the main thing that the Fed is looking at in order, that would eventually get them to reverse current monetary policy is the labor market. So let's take a closer look at some of the economic data associated with the labor market to see what the Fed is looking at, to see what those trends are telling us about the likely future course of Fed monetary policy. So again, I think of this in kind of two parts. There's the inflation picture and there's the job picture, the labor market. So as inflation creeps higher, it increases the likelihood that the Fed will need to reverse its current easy money policies, right? And here we're looking at CPI, the Consumer Price Index, which is one of the core measures of inflation. And it's clearly much higher, right? We're seeing this spike higher, inflation moving up and accelerating. Now, I think this looks a little worse than it is because we're looking at year over year. So this is compared to the same time last year, which was right on the other side of the initial coronavirus fallout, which was a deflationary environment, right? So looking here, we saw inflation moving lower. So deflation. So this reading looks worse than it is as we're comparing to the same time last year. But that doesn't mean that inflation isn't here, because it is, and it's increasing on a nominal basis and it's accelerating. So there is inflation. Now CPI is only one measure of inflation, and it's not the central measure that the Fed uses in their decision making. That's the PCE, Personal Consumptions Expenditures, which will be out May 28th, so next week. So that'll be a big piece of data that we'll want to take a look at next week. But this has really been spooking the market and making investors more fearful of a reversal of current monetary policy. But all in all, that side of the story is that inflation is definitely on the rise. Now, the Fed has continued to reiterate once again, though, that the main thing that they're looking at is the labor market. So they've said continually that they're going to want to see several months of improvement in the job market before they consider reversing current monetary policy. They've also said their current view is that inflation is transitory. Now, I don't know if I necessarily agree with that, but I do think that inflation fears are a little overdone here in the near term. But let's turn to the labor market to get a better handle on what's going on there and the likely effect that that's going to have on the Fed's monetary policy moving forward. First up, we'll look at initial claims. Now, this is a measure of how many people are filing for unemployment for the first time. So this number moving down substantially over the last year as the economy has generally improved and the labor market has improved. So this tells us that there's been an improvement in the labor market. Notably, though, that's an improvement from the worst of the coronavirus fallout. So if we zoom in a little bit, we'll look at, back to January of 2020. We see that while it's gotten much better from the worst of it, it's still above where it was pre-coronavirus. So right now, 444,000 new initial claims. Pre-coronavirus, we were more like 200,000. So still about twice as many initial claims as pre-coronavirus. So it tells us that we're still not back to where we were before the coronavirus fallout. And that's going to be an important factor in the Fed's decision making. So while there's improvement, it's still not back to where it was. Here we're looking at the all employees total non-farm payrolls. Now this is a measure of how many people are currently working, more or less right now. So again, seeing an improvement as this number has moved up, but still not back to pre-coronavirus levels. So notably still not back to where we were before the fallout. This is where things start to get interesting. We're looking at the job openings, total private job openings right now. So that's telling us how many jobs are available right now. We're seeing a huge spike in this recently. It's telling us that companies are hiring again, but we still have, relatively higher unemployment, at least relative to pre-coronavirus. And we're still not back to where we were as far as the total non-farm payrolls, as far as people that are actually employed. So it's telling us that right now there's a lot of people specifically not taking new jobs. There are several factors playing into why that is. We still have unemployment insurance. It's kind of disincentivizing workers to get back to work. We also have the fact that there's a lot of schools in general still are distance learning, right? So there's a lot of parents that can't really get back to work because they got to be there to watch their kids, and because childcare is extremely expensive. So if it's a net negative to put your kid into childcare so that you can get back to work and you're not making substantially more money than you were on unemployment to do that, then why would you? So increased unemployment insurance and continued distance learning for kids, two important factors that continue to disincentivize people to get back to work. And they've had the effect of making the labor market slower to recover. But what's likely to change? Well, first of all, unemployment insurance programs at the state level, states are starting to think about ending their enhanced unemployment insurance programs, right? The PUA, Pandemic Unemployment Assistance Programs. So as that happens, there will be less of an incentive for people to stay unemployed because they'll no longer receive those enhanced benefits. And that's starting to roll out here, mid-June into early July. There are several states that are going to start to roll back those programs. And again, that's going to get rid of that incentive to keep people unemployed. Also, schools are going to return to normal in-school learning, right? We're coming up on summer break, but come the beginning of next year in September, we're going to see a lot of schools across the country starting to fully reopen and starting to have all of their students back in school. So that's going to be another incentive being taken away for people to stay unemployed, because now their kids are going to be in school and they can get back to work. So as those incentives are taken away, my current thought is that we're going to start to see huge improvements in the labor market over the next several months. And that's what's really going to turn the dial for the Fed. That's what the Fed is going to be looking at. And as the labor market improves, they're going to be more and more likely to reverse course on their easy money policies. Couple that with the fact that inflation is on the rise and accelerating, all of a sudden you have kind of a perfect storm of reasons why the Fed will start to revoke its current easy money policies. They'll end or start to taper their asset purchasing program, and eventually they'll also start to raise rates, especially if inflation continues to rise and accelerate at the pace that it has been. So while I think that the current very near-term stock market fear of inflation is a little overdone, I mean, it's pretty apparent that inflation is on the rise, it is accelerating, that the labor market is likely to continue to improve, and in fact probably accelerate at a pace that maybe the market isn't expecting. So a major headwind for the market as the Fed is more and more likely to reverse monetary policy. So what are the effects of that? Well, if they reverse monetary policy, yields are likely to rise. As yields rise, it puts a dampening effect on economic growth because it's more expensive to take out new debt to fund new growth, right? Also, as yields rise, the dollar becomes more attractive, particularly to foreign investors, because as yields rise, U.S. investments look more attractive, especially when you consider the fact that yields across most of the world have gone negative on both a real and nominal basis. So as yields start to rise in the United States, foreign investors start to exchange their foreign currencies for dollars so that they can chase the more attractive yields here in the United States. So, that increased demand for the dollar increases the price of the dollar, increases dollar strength. That would have the effect of putting a big headwind on the commodities market, which once again has a strong inverse correlation to the US dollar. But then as the US dollar strengthens, US investments become less attractive to foreign investors because their foreign currencies are weaker relative to the dollar. So that's kind of a linear explanation of a bunch of things that don't really happen linearly, right? All of this stuff affects each other all at the same time. So is that exactly how all this plays out? I can't be sure, and there's not enough data to know exactly how this all unfolds. But those are the big scenarios that are likely to happen based on the economic data. And as we get closer and closer to the end of Q2 and into Q3 of this year, it's looking more and more like monetary policy is likely to reverse course, and that's going to create a major inflection point in the stock market, and in particular asset classes and sectors of the stock market. So if the current trend in inflation continues on its current trajectory and the labor market improves and really starts to improve like I think it might over the next couple months, we could expect that reversal of the current monetary policy and a major inflection point in the stock market here in the back half of the year. So a lot to be thinking about there. We'll keep tracking the economic data to help us figure out what the Fed is likely to do next, and importantly, when they're likely to do it. That's it for today, folks. Obviously, and per usual, a ton to be thinking about. A lot of economic data to be considering these next couple months and the likely implications that'll have on future Fed monetary policy and the likely future course of the stock market. Before we wrap up, don't forget to hit that like button, subscribe to the YouTube channel, visit us over at marketbarometrics.com, and until next week, have a fantastic weekend. We'll see you next time on The Big Picture.